Hey there, Steven here. I got an awesome lesson for you guys today. A lot of people have been reaching out to me saying, Steven, what is the one thing that separates you and all of your market heroes from the 99% of investors out there? What's the one thing that the top 1% of all investors know that I don't know that's holding me back from being a big success in the market? Well, I got bad news for everyone, so I hope you're sitting down. I got bad news. It's nothing sexy. It's nothing pretty. It's very, 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 very basic. And we're going to get into that in this video. So it's very exciting for me to get this out there. I have one of my students who followed this rule that turned their account from in 2016 being down about 15% to 2017 being up over 60%. Just following this one rule. Again, guys, the title of this video, the number one investing rule that you are not aware of, right? Hold on, I'm reading it wrong. The number one rule of investing that you have never heard of before. Again, guys, it's not sexy. It has nothing to do with charts. It has nothing to do with balance sheets. It has nothing to do with any of that stuff. It's just basic common sense to allow you to stay in the game and allow you to grow your account over time. So I'm clicking buttons. I'll see you guys inside the computer. What's up, everyone? We are inside the computer. We're ready to rock and roll. I know that a lot of you guys have been asking me questions about the topic that we're going to go over today, so I'm super pumped. I'm really excited to talk to you guys about it today. Now, I want to warn you, like I mentioned in the preview, this is not something that's very sexy. This is not something that is the latest and greatest. This is not something that you could put on a chart. This is not an indicator. Right, this is not a Fibonacci. This is not something that would have required you to go to the Wharton School of Finance. The number one rule of investing that you've never heard of before is very simple. It's very logical. It makes a ton of sense. And when you see it, not only might you be a little bit disappointed that it's not the latest and greatest, there's no fireworks, there's no bells and whistles, but it will make a lot of sense to you when it's broken down to pure numbers and pure statistics. It's going to make a lot of sense. This is kind of a common sense rule of investing that you've never heard of before. So this has been my biggest secret in terms of how I've been able to not only stay in the game, but have been able to see consistent returns over many, many years. You know, I've been investing in the market for over a decade now. And in that time, I pretty much started during the financial crisis. You know, if I wasn't doing this number one rule of investing that you'd never heard of before, there's no way I would have been able to get through 2008. There's not a chance I would have been able to get that through 2008. And even better, 2010, we saw a very big flash crash. 2011, we saw a 20-point sell-off with the European debt crisis. You know, 2015, we saw a pretty big sell-off with the Asian markets and their currencies. So we've seen a lot of pretty nasty stuff over the last couple of years, at least in my investing career, that if I wasn't following this number one rule of investing, there's no way I would still have an account. Absolutely no way I would have had an account, let alone do really, really well. So I want you guys to put this into context. The way this lesson is going to go is we're going to talk about the number one rule. We're going to go into some numbers about it, and then I'm going to show you how helpful just this number one rule was to one of my students who took their account from being not good in 2016. This person, which you'll learn about here in a couple minutes, lost about 16% in their portfolio, and in 2017 they made almost 60% on their money. And again, all that person did was just utilize this rule the right way, simplified everything, and for him, really saw some awesome returns. So size matters, guys. Size matters. And I'm not going to keep you guessing. I'm not trying to keep you on this video for too long. This is going to be a pretty short video. But the number one rule in investing is keeping your trade size small. That's it. Telling you in 2008, if my trade size was not small, I would not have an account right now. I would not be here teaching you this information. I would not have all my market heroes, and I would not be able to make them be successful if my trade size was too big. The number one rule of investing is keep your trade size small. That's it. And again, we kind of touched about it, but it's not sexy, right? But this is what the top 1% of investors are doing every single day. if you look at the accounts and the K1s from hedge funds, you'll notice that they have dozens and dozens and dozens of positions in their account, right? That means that no one position can be so big. But if you look at some of the individual investors out there, some of the retail investors, the moms and pops, well, they have like 3 stocks in their portfolio. A clear difference there is the institutional investors in the hedge funds, their trade size is very, very small, at least how it compares to their overall portfolio. Where you look at a normal retail account, an individual account, a mom and pop, they have like 2, 3, maybe 4 stocks in their account, and that's it. And that's a major, major difference. A major, major difference. And obviously, with small trade size, you get a ton of benefits. So what are the benefits of small trade size? Again, guys, the number one rule in investing, the number one rule is keeping your trade size small. That's it. So keeping your trade size small allows for emotion to be removed from investing. Let's take a look. Let's think about this for a second. If I have an investment and the stock goes down, let's say 2%, a $500 loss is going to dictate, and I will be thinking about that, and I will be hurting a little bit more over that investment, and I'll become more emotional over that investment, as opposed to if I only lost $5 on it, right? So that totally makes sense. The bigger the stakes, the more irrational people get, the more emotional people get. People invest their hard-earned money. People take their year's salary and put it into their investments. Because they want to grow. They want to grow and do things like save up money for their kids to go to college, or to go on vacation, or to buy a second home, or buy a first home, right? So when there's so much money at stake, the more money that gets at stake, the more irrational people get. When you have a very small trade size, that isn't really a factor anymore. Small trade size allows for optimal diversification. The example of the hedge funds that have dozens and dozens and dozens of positions, as opposed to the individual that only has 3 positions. It's very difficult for a 3-position portfolio to be diversified. However, when you have dozens and dozens of positions, right, dozens and dozens of positions, it's very easy to have a diversified portfolio. Small trade size allows for a lot of cash on hand when new opportunities arise. If you are only putting small percentages of your account into each investment, sometimes there aren't enough good opportunities out there. So what happens is you invest as much as you can with small trade size into many opportunities, but there's still cash on hand. If you only have 3 positions in your account, you're going to want to go all in because you want the money to go out there and work for you. And finally, obviously, small trade size being diversified, it allows for no one individual stock to take down the entire portfolio. If you have a 3-stock portfolio, and one of those goes to the tank, your whole portfolio is going to be hurting. However, if you have dozens of positions, and one position goes in the tank, your whole portfolio might not even be affected. And that's the last kind of benefit of small trade size. So let's kind of look at the numbers here for a second. Let's look at the numbers to see what the optimal trade size is. So if we have a portfolio comprised of 5 positions, which again is not atypical, which is not irregular from a normal individual retail investor account. When I say retail investor, I'm saying non-professional. So a normal retail non-professional account may have 5 positions. Now let's say each of those positions gets 20% of the value of the portfolio. That totally makes sense. I'm sure people who are watching this video, that has happened to you or is currently happening to you. And we decide with those 5 positions to buy stock with each of them. What are the chances, mathematically speaking, our account goes to 0? Now again, guys, there's no emotion involved in this, right? We're not talking about, oh, stocks go up over time, or the Federal Reserve this, or earnings that, or tax reform that, or charts this. This is just pure numbers. If we have an account with 5 positions and every position gets evenly distributed based off how much is in the account, so all 5 positions get 20% of the account, what are the chances the account goes to 0? Well, they're actually 1 in 32. And again, it's just mathematically speaking. Now, I don't know about you guys, but I have no interest having a 1 in 32% chance of my account going to 0. So let's take it a step further then. Let's try to figure out if 10% is the right trade size. So now, what if we had 10 stock positions? with 10% of the total value of the portfolio going to those 10 positions. What would the chances now be? Well, if all you do was had 10 positions instead of 5, you went from a 1 in 32 chance of going busto to a 1 in over 1,000. But to me, that's still not even good enough. I want to take it a step further. A 1 in 1,000 could happen. What about now 20 positions? So we went from 5 positions, which is 1 in 32 chance of going busto. Then we went to 10 positions, which is 1 in about 1,000. With 20 positions, each getting 5% of the total value of the portfolio, you have over a 1 in a million chance of your account going busto. And this is kind of the sweet spot for me. I obviously have a lot more confidence that I could go out there, make a lot of trades, make a lot of really good trades with a very, very, very small chance of really getting hammered with my account, and an even smaller chance, better than 1 in a million, that my account is going to go to 0. So, what's our number one rule of investing? No single trade can require or have more than 5% of the entire portfolio. That is it. That is the line in the sand. That's it. No single trade, no single investment can use more than 5% of the entire portfolio. That is it. That is non-negotiable. No questions asked. It's the only reason why I'm still able to sit here with you today and give you this information. It's the only reason why I'm still able to go out there every single day and try to make as much money as I can in the market. It's the only reason why I'm able to be here and teach all my market heroes how to make money day in and day out in the market. And on top of that, it's the reason why some of these top guys, the top 1% of all investors, able to make money every single year. It's because they have a lot of positions. Now, 5% is the top. It can't go over 5%. But you could have positions, and you'll see in a second, one of my students had positions much smaller. 2% of the portfolio, 1% of the portfolio. 5% is the tops. No one position can have more than 5% of the entire portfolio. So in a $2,500 portfolio, no one position can take up more than $125. In a $10,000 portfolio, no one position can take up more than $500. And in a $30,000 portfolio, no one position can take up more than $1,500. That is it. That is non-negotiable. I will say this. If you're interested in making an investment or trade that is more than 5% of your portfolio, you are taking a risk that is too much. Too much. There are so many opportunities in the stock market on a given day. There are thousands of them. That not one opportunity is so much better than others that it's worth risking losing your entire account. So don't do it. So, I told you I was going to tell you a little bit of a story about one of my students. This student, his name is Kevin. He came to me at the end of 2016, and he was kind of all over the market. He was done with the market. He's like, the market is rigged against me. Right? I feel like it's just rigged for the top 1% of investors. Right? I feel like even though sometimes I make money, when I make money, it's small. And when I lose money, it's really, really big. And I'm ready to throw in the towel. I don't really want to do this. The money I'm making from work, I'm putting into my portfolio. And I hate to see that I keep on losing and losing and losing. So can we work together and let's see what happens? So he was a student of mine starting about a year ago, and we worked together once a week for a year, and we made some adjustments to what he was doing. And let's see when he came to me, this is what it looked like. So when he came to me, the starting value of his portfolio was $15,000. And what it turned out was, when I want you guys to look at down here, his average trade size was $3,500, which was about 25%, 23% of his entire portfolio. Remember, he was just like the examples that we've been using here. He was just like this example. He was like this example, the first example. He could only at any given time, if every single one of if he had a $15,000 account and each of his investments averaged $3,500, right? He can only at the most have 4 or 5 investments at any given time. Kevin, when he came to me, had a 1 in 32 chance of losing his entire portfolio. That's why he felt like hey, I'm making money, but when I make money, it's tiny. When I make money, it's really, really small. And when I lose money, it's really, really big. That's exactly why. And the reality is, with a $15,000 account, he should really only have put only $750 at the most, because that's 5% of the account, into any one investment. So we worked together. I told him some of the strategies that I teach my market heroes, and I teach some of my one-on-one clients, and we worked together a little bit. But ultimately, the biggest thing for him was, I said, Kevin, look, you're getting too big in your investment size. Our rule is no investment can have more than 5% of the total portfolio involved. When I looked at his strategies, he was actually making some really good strategies. The problem was his investments were too big, and anytime he took a loss, it became very, very emotional for him, and he became very, very, he started thinking too hard. He started getting worried because the size of his losses were big. So he wasn't making the right decision. He wasn't giving his trades time to be right. So I said, cut down on your trade size. No one trade can be greater than 5% of the entire portfolio. In 2017 was a much different story. Now, forget the fact that he went from, in 2016, down 15% to 2017 up 65%. But what he really did was special, because he really, really made it very, very important to him that his trade size had to be very, very small. So with the starting value in 2017 of about $13,000, $12,730, 5% of that is about $636. So he took it to an extreme. His average trade size was less than 5%. It was just $300. And what's very, very interesting is that just allowed him to give his investments more time. It allowed his portfolio to become diversified instantly, right? And if he had a trade that became a sizable loss, well, that didn't really affect him as much as it used to. And that's really what the difference is. Guys, what is the rule? The rule is not any single investment can be larger than 5% of your total account. That's it. And take it from one of my students, Kevin. The only thing he did different was cut down dramatically on his trade size. That allowed him time. That allowed to give his investments time to be right. It allowed him to remove emotion from his investments. It instantly allowed him to become diversified, because instead of having 5 positions at the most, he was able to have many. It allowed him to have a lot of cash on hand for when excellent opportunities arrived. And when one position went severely against him, it barely moved the account. The reason it moved the account was because his average investment size was only about 2% of his entire portfolio. If you have one investment that's 2% of your entire portfolio and it goes to 0, that is barely a dent to your entire portfolio. It's much, much different psychologically. So guys, what's the rule? The number one rule of investing that you never heard of was no single trade can be greater than 5% of the entire portfolio. That's it. Non-negotiable. End of story. So there it is. Now you guys know what everyone else doesn't know out there. You guys know what all the top 1% of investors know, what the Warren Buffetts know, what the Jack Bogles know, what the Stephen Brookses know. Now you guys know exactly what the top 1% of investors know. Their number one secret, the number one rule of investing: keep your trade size small. And again, beyond that, take it a step further. No one investment can have more than 5% of your total portfolio invested in it. That will allow you to stay in the game. That will allow you to be diversified. That will allow you to keep cash on hand if good opportunities arise. And more importantly, if one of your positions goes wrong, it will allow you to stay in the game and not have your entire portfolio dragged down. So if you stay small, you'll stay in the game. If you stay small, emotion won't take over. And if you stay small, no investment will be greater than 5% in your portfolio. And I promise you, it will change things. So thanks for tuning in. I'll see you guys in another video.